According to the Federal Reserve Bank's latest Beige Book, modest to moderate gains in the U.S. economy are just ahead. Consumer spending appears to be rising across a majority of districts, led by increases in non-auto retail sales and tourism, said the U.S. Central Bank's report. Published every 6 weeks, the Beige Book summarizes economic data collected by the 12 Federal Reserve districts. In the 32-page mid-July report, many districts noted softer consumer spending, particularly in auto sales, which declined in 6 districts. But it's likely auto sales were merely reverting to their long-term mean rate after surging way above their long-term norm in the long comeback from the Great Recession. Here's the evidence. The proof is in June's report, showing total retail sales which, compared to a year earlier, grew by 3.2%. That's stronger than the 3.1% peak achieved during the last economic expansion. While auto sales can be volatile, total retail sales are nonetheless doing just fine. Meanwhile, Fed Chair Janet Yellen, in congressional testimony, reiterated that she expects to continue the gradual upward course of rates in the face of growing economic strength, even as inflation declined sharply in recent months. The so-called headline inflation rate that is almost always cited in the financial media, the Consumer Price Index, started a nosedive in February and on June 30th was at just 1.6%, plunging from 2.8%. Ms. Yellen has been quoted in the press as saying wage inflation is on the way and, as a labor economist, she should know. Wage inflation is evident in the core CPI, which indexes the monthly expenses consumers pay, but excludes food and gasoline. Lower gas expenses have masked wage inflation, evident in the core CPI rate. A strong labor market and rising imports are likely to make the disinflation temporary. Consumers are not overly optimistic. When consumers become giddy, it could be a signal of trouble ahead for the stock market. The dashed black line represents the mean rate of the Consumer Sentiment Index since the University of Michigan began this monthly survey nearly 58 years ago. Optimism is not approaching the peaks of the tech stock bubble. For a bull market to continue, optimism can't be so widespread. You always need skeptical bears on the sidelines that may eventually capitulate, change their minds, and purchase stocks. In early July, 63 economists gave the Wall Street Journal their forecast for 5 quarters, and the consensus prediction was that the U.S. would grow an average of 2.5% quarterly. The 2.5% quarterly forecast is a small revision downward. It stemmed from a reduction in the forecast for the quarter that just ended on June 30th. A handful of economists, politicians, and pundits say a 2.5% growth rate is not that good and that 3% growth or more is possible. But the math driving America's economy makes growth higher than 2% unsustainable. Demographics and productivity, the key factors, cannot reasonably be expected to make a 3% growth rate sustainable. And don't turn your nose up at a 2.5% growth rate. Economic horse sense tells us that 2.5% is pretty darn good growth. In fact, it would significantly outpace the nonpartisan Congressional Budget Office's 10-year projection of less than 2%. The key growth engine in a diversified portfolio, the Standard & Poor's 500 Index, has been hitting new all-time highs repeatedly for months. Unexpected bad news could plunge stock prices by 10 or 15% at any time, but the outlook for economic fundamentals that drive stock prices remains bright. Broadcasting at a frequency you can pick up right from your smartphone by subscribing to our YouTube channel and email newsletter. We are independent financial professionals analyzing facts affecting wealth management,